Mayuresh Joshi, Head of Equity Research at Bloomberg India, is joining us right now on the show. Mayuresh, we've digested earnings. Yeah. It's behind us now. What I guess we're on the lookout for is the severity of how much coronavirus can scale and the impact of that on domestic companies as well as the global business.
Oh, absolutely. Morning, Devina. Morning, Neeraj.
Good morning.
So I think the entire focus is absolutely going to shift in terms of the global impact of coronavirus and the implications on a lot of sectors out here, right? So again, when you hear con calls for a lot of companies, auto component makers, for example, I think they're clearly indicating that if this extends for a month or 2 months longer, I think the disruptions in the supply chain are going to be very, very disruptive. So I think a clear indication has been given at 10-20%. That's the range that the hit can be. The other element also is the pharma companies, right? Because a lot of APIs which come from China, almost 80% is imported from China. So prices of few APIs like ibuprofen, paracetamol, have actually shot up, and these are critical components in terms of finished dosages for Indian companies. The third element obviously is also the stock for a lot of agrochemical companies in terms of imports that they probably do. I think the companies which are better off in terms of being backward integrated are better off in a scenario like this, because I think the pricing probably works in their favor because of the disruption. But yes, you're absolutely right. I think disruptions are here to stay. We're just hearing Neeraj say, right, a lot of MNCs have also started indicating, Apple, for example,
yes,
and so on and so forth. So there are disruptions around the corner. And yes, that will have a hit in terms of global GDP and how global trade functions. So I think the markets are probably trying to get a feel in terms of the kind of potential impact in terms of the economical implications that it might have.
But Mayuresh, just before we get to the other big announcement, which is the media restructuring announced at the Network 18 group, just continuing with that conversation, there is an MK note, for example, which speaks about how some of the battery makers might benefit from this issue at China. And some of the specialty chemicals companies which are not very well backward integrated, and they have named, I think, companies like Vinati Organics amongst others, Camlin Fine amongst others. Yeah. Now you track this space very closely. Do you think the impact on a Vinati, a Camlin, or some of the others that you may have an idea of would be very severe, and will it show up quite strongly in Q4?
No, so as I mentioned earlier as well, right, a few companies like this, Vinati, for example, I think if you hear their management con call, I think the impact is supposed to be very, very minimal as per the management itself.
Okay.
PI Industries, I think, an agrochemical player as well, I think outstanding set of numbers in my opinion. Again, I think the dependency of China in terms of imports and again the inventory that they have is sufficient enough for Q4. But even if this extends beyond Q4, I think the management was very, very clear. They're just talking about single digits impact in terms of top line. So I think a few companies benefit significantly because I think the pricing pressures that will get witnessed by the other companies will be quite significant. So yeah, I think a few of these specialty plays can actually benefit from China disruptions very, very largely, because export orders are also firming up for all these guys.
Okay.
Add to that list is obviously the list of the Network 18 stocks. So you've got Network 18, you've got Hathway, Den, all of these to watch out for. Mayuresh, come in on this piece, the consolidation that's happening. Obviously, it's going to work well because it'll create a leaner, corporate structure. Talking of net debt-free company with a solid base for growth, do you think this will go well?
So yeah, I think it was in the works, right? Because I think the consolidation and the restructuring exercise that has been done, I think the accessibility in terms of different segments is now far more feasible through one single entity. Having said that, again, I think looking at the swap ratios, Hathway and TV18 definitely benefit, and with the kind of exercising or the restructuring that they've probably done, Network 18 obviously reduces the holding discount. So yeah, I think it's sort of positive for all these companies taken together.
The only thing is, Mayuresh, I just want to ask you that from a swap ratio perspective or from the fact that the holding company discount goes away, so from a technical perspective, all three companies tend to benefit. The question is fundamentally, media business is not quite making money, right? Sure. We've seen Sun TV, Z has issues of its own, but Sun TV as well. Yeah. ENL talking about pressures on the radio business. Is there fundamental sense in trying to own these companies in a big way? even though it may be a really large media conglomerate, or would you believe that there are better businesses to bet on?
No, I think the businesses will take time because what they have gone through, I think, and if you combine all the factors that you put through, I think ad revenues is a substantial portion for media business. You guys know it better, right? And that has probably come off significantly. For the print guys and the radio guys, I think it's more the diversification in terms of small businesses, local businesses, how FMCG companies are willing to spend, and that creates a huge multiplier impact in terms of how ad revenue growth is seen going forward. The subscription growth for a lot of these broadcasters, I think, have been on the softer side. So whether you call it because of the tariff order or the new tariff regime which has come through, again, I think the benefits are there to be seen as they try and entrench further in terms of market share gains. There is elements of consolidation happening within the industry itself. But I'll still wait it out. I think the softness in numbers still continues. I think it's better to wait or stay put, wait for a quarter or two, see how it goes, and then probably take a call. The interesting data point, however, is that I was reading through a couple of media reports in terms of the ad spends which are expected to come through. So television, I think, is going to get the maximum chunk, followed by digital. So I think the disruptions, as you're pointing out since morning, I think the digital part of the business probably is going to see significant money coming in through ad revenues. And print probably comes third. So you can see the kind of disruptive impact that is probably going to happen in terms of the channel effects, if I would call it that way.
We were also earlier on talking about the results of the FMCG companies, staple companies, and how they've been impacted this quarter. What would you do, Mayuresh, if you did have some idle money lying where you wanted to deploy and no consumption exposure in the portfolio? Would it be a right time rather than to have that exposure?
Yeah, it would, because time and again, I think we have been discussing how the Rabi season has been, right? And the consumption multiplier obviously has deteriorated because rural consumption has actually grown at 0.6% compared to 1.5 times of urban. So to that bit, again, the expectations of a good Rabi harvest, the expectations of realizations growth coming through at the end of quarter 4 will prop up volumes and expected price volume realization as a leverage on FMCG or staple balance sheets. However, I think input costs have also risen significantly. So if you look at, say, for palm oil futures, I think those prices have shot through the roof. Milk prices have gone up by 3 to 5 rupees a litre. Sugar prices have gone up. So it's an automatic reaction that they will pass this through, and how much of an impact does that have on volumes is interesting. But again, I think to probably look at the sector as a whole, I think we find it very, very interesting. I think paints as a segment, in my opinion, should do well. So I think we are doing this interesting piece in terms of post-result analysis, Asian Paints versus Berger. And the kind of growth that Berger has exhibited on the top line and bottom line compared to an Asian Paints has been significant, at least for the 9 months for this fiscal year. However, I think with new capacities coming up and expectations of asset turns actually improving for Asian Paints, EBITDA margins relatively better, crude derivatives coming off, are a significant component for input costs. And obviously the element in terms of return ratios, I think, remain extremely strong for Asian Paints. From a valuation perspective, I think it is trading at a 25% premium to Asian Paints at this point of time. But obviously Asian Paint is a leader, so our methodology absolutely suggests sticking with leaders, sticking where earnings momentum is. So yes, as a theme, our canceling methodology is actually throwing up Asian Paints to be a very, very good bet within the consumption space.
Well, it'll be interesting. I read somewhere on social media yesterday that JSW is entering into the paint segment with some brand called Halo, and their pricing is very disruptive. And let's see if that can happen. Sorry, you want to make a point?
So I think there
was an issue with the Competition Commission that JSW itself had raised regarding against Asian Paints.
Exactly. So that's one element of it. The second element is obviously, even if competition comes through, right, the paint segment is divided into 3 segments. So distempers is where the high-end paints are, emulsions where the mid paint segment lies, and obviously the lower segment. So I think the category that a lot of these paint companies will cater to will be targeting on the emulsions part. Asian Paints is more or less distemper. So I think repainting demand expected to go up, urban demand expected to hold, and rural demand expected to catch up. I think market leaders will catch up on the earnings.
And maybe that's why, despite the last decade of falling return ratios, have not deterred the P multiples. I mean, the ROC of Asian Paints has come off quite dramatically in the last 10 years, to be honest. But people are valuing growth in a different fashion right now. and especially companies which are throwing up good cash flows. So maybe that's why this works beautifully for Asian Paints. The other big mover, or the big newsmaker rather, it's not been moving that much, but the big newsmaker is the power deal that has been struck between JSW Energy and GMR. Now, have you looked at that, and does it benefit the seller or the buyer? The seller because they get some money to repay debt or whatever it is, and the buyer because they get an operationally asset which is accretive from day one?
No, I didn't look at the granularities of this obviously, but the way I look at the sector is that the realizations are obviously come off significantly. The second element obviously with this acquisition, and obviously I need to see that piece very, very frankly. But again, I think it's not something which is going to be accretive from an immediate perspective, right? So I think one needs to really look at this from a granularity perspective and the valuations as well. So I think the enterprise value, as I see it on the screen, 5,321 odd crores. I think one really needs to justify that from a realization and the end user perspective as well. I'll take it with a pinch of salt.
Okay, let's wait and watch what happens. Remember, for GMR Infra, it might be a bit of a positive as well. They get some money, much desired money. The Tata deal hasn't quite happened as yet. So this might be a shot in the arm, but too early to say. By the way, Yes Bank comes out of the FNO ban, so you got to keep that stock at the back of your mind. Up marginally in trade. Let's wait and watch if that one reacts further. You know, the one that has really been clobbered the last few days, weeks, is Mahindra and Mahindra, down about 1% in today's session as well. Mayuresh, there was some story about how the newer tractors from October will have to have a glass cabin, etc., all of which increases the cost too. So that's an added negative. But the fact that the stock has come off so much compared to any of its peers in the tractor space or otherwise, would you look at it, or is it down for a reason?
I think two elements to this. The first element obviously is that the numbers were a little bit softer on a consolidated basis as well, including MVML. So the UV part of the business, how the entire transitions happens from BS4 to BS6, because the large portion still remains diesel with these guys. The kind of discounting that they'll have to do and the kind of price increases they'll have to take for BS6 variants, they'll obviously have an impact in terms of how volume activity will play out. The second element in terms of their farm equipment business, which is the tractor business, right? And if you compare it with its peers, Escorts, for example, had a very stable run in the quarter gone by. Unfortunately, I think the emission norms that you're talking about is applicable for 50 HP plus coming October.
No, not just the emission norms. There was a Times of India article which said that the new tractors for driver safety will need to have a proper cabin, glass windscreen, etc., etc., all of which is a cost enhancer.
It is. But I think the portion that they probably also have in terms of the mix, 50 HP and less than 50 HP, I think that is also going to have a significant say. The second element obviously is that as you're expecting BS6 pre-buying, right, there will be pre-buying that will happen even for the tractor front. Now with a good Rabi season, the expectations of the Doppler estimates are actually suggesting that rainfall will be quite normal this time round as well. So there is expectations that with realizations coming through for Rabi, I think the farm equipment part of the business should improve. But I'll still prefer something like an Escorts if somebody is hanging on to it, to hang on to that stock, because what they've probably done in terms of the mix that they've got for farm track and power track, which is their above 50 and less than 50, the mix is largely improved greatly in favor of the less than 50 HP tractors that they've got. The realizations probably are expected to remain extremely stable, and the construction part of their business is highly underutilized at this point of time. So if infrastructure activity, as one presumes and assumes, will pick up, I think they might significantly benefit in terms of the fixed cost absorption for the construction business actually playing out positively. And the railways is doing wonderfully for them. So I think 450, 500 crore order book, brilliant EBIT margins. And the balance sheet also does not have too many issues. So I think we discussed this in the past as well. I think if you've got Escorts, continue holding.
Okay. Anything else that you like, Mayuresh? We were talking about solar industries.
No. You're actually having a look at that stock. But something that we like at this point of time is PI Industries that we spoke about in the morning, right? Post the results and post the con call, I think the top line growth was 20%, the EBITDA growth was 25 odd percent. They're also looking at a capital raise of 2,000 odd crores. So the organic, inorganic route they're probably pursuing beyond agrochemicals, I think that is something that will work in favor of these guys going forward. The CRAMS business, which accounts for 74%, has a brilliant order book size. So I think the execution thereof, supply side constraints in China, are obviously going to benefit. And as I mentioned earlier as well, they're probably looking at different segments, maybe pharmaceuticals, nutraceuticals, which can be a huge value add going forward and a huge balance sheet plus as I see it. Debt equity absolutely minimal on their balance sheets. Return ratios are very, very solid at 20 to 23 odd percent. And what you're looking also from disruptions of China, as I said, that will be single digits even if it happens beyond Q4. So I think this is one stock that we are probably looking at. It perfectly fits our cancel methodology in terms of earnings growth, institutional ownership, leadership that they probably got within the space itself. And again, the return ratios, which is higher than our 17.5% mandated level that we got.
Okay. All right. We're just minutes away from market opening to tell you all that you need to know to stay ahead in trade today. Reliance Industries is consolidating its media and distribution subsidiaries under one roof by merging TV18 Broadcast, Hathway Cable and Den Networks with Network 18 Media and Investments.
24 bidders submit expressions of interest for full or part of DHFL's businesses. KKR, Bain Capital, Arcil, Oak Tree Capital and a few others are in the fray.
JSW Energy signs a share purchase agreement for 100% stake in GMR Kamalaga Energy for an enterprise value of 5,321 crore rupees. The management says the acquisition's value accretive from day one.
JSW Steel has been declared a preferred bidder for 3 iron ore mines in Odisha with combined resources of 1,092 million tons.
Putamaki VPL reports a 10% top-line growth in the third quarter, while a 32 crore tax write-back is the bottom line.
And lastly, in key brokerage calls, Nomura has cut the price targets on BHEL to 33 from 48 rupees owing to weak order inflows in the year FY20. Well, that stock certainly been caught on the wrong foot a number of times. By the way, Vodafone Idea corrects a bit in trade today. NMDC, Nalco are amongst the metal names that are also correcting in trade today. Frankly, save for media, I don't think too many other stocks have done really well on open. JSW Energy, though, is up about 3%, so keep that at the back of your mind. But it's all media. Hathway, Den, TV18, HT Media, Network 18, TV Today, Jagran Prakashan. That's the clutch of names that have done very well in trade. Mayuresh, just a quick thought, a quick follow-up, and that is on IRCTC. There's a bit of a pause after a really good run. Would you use this as an opportunity to buy?
No, so we just came out with a very interesting take on IRCTC and DMart both, right? And we tried to compare that with the outstanding show that our cricketers have got. So, Sachin and Virat Kohli, right? So the outstanding show on the cricket field that they've displayed over the past so many years, I think these guys, Poros's listing, have not seen anything which might be boggling in terms of either a drop or something like that. So they've defied gravity in every sense. So again, the business model is working absolutely fine in terms of the catering business. The kind of online orders that they're getting have improved significantly. What you're seeing in terms of the online ticketing, again, that's a cash cow because the EBIT margins there are huge, anywhere to the tune of 80-85%. They've launched a third train, which the PM probably inaugurated yesterday, right? So the Tirth part of the business, which is a pilgrimage bridge part of the business, is also expected to pick up. And again, the kind of cash flows that they probably throw out, I think it's stupendous at this point of time. So I think it's just moved strength to strength, waiting for some point of an entry, but I think it's moved far, far higher from our pivot levels. So I think as Sachin is the demigod of cricket, right?
But if you expect the growth to continue, then even this should not be a hindrance, right?
It might, right? Because
year-on-year growth.
So the interesting part, Devina, is the valuations, right? The day they listed and the day that they closed, right? The valuation had become 70 odd times for IRCTC, right? Now they're trading at a valuation of 130 odd times in terms of price earnings. So it's not cheap, right? Sorry, around 70 odd times. DMart is around 130 odd times. So it's not cheap by any sense. But the growth is still expected to come through. Now, competition will come through on the private line, but that's still going to take time. So my sense is that it's a stock that if one owns, should own, it's way extended from our pivot levels that we've got.
Mayuresh, we'll take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning.